Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, who just retired from nearly 50 years of being in the brokerage business in BC. His website, victoradair.ca. Welcome back to the show, Victor. And because it's the first time we've talked since the turn of the new year, Happy New Year.
Well, thank you, Jim, and Happy New Year to you and all your listeners.
Joe Biden was inaugurated today as the new president of the United States. The major American stock indices are at all-time highs. The Dow Jones has risen about 5,000 points, or about 19%, since just before Biden won the election. Why has the stock market rallied so much, and does politics now have bigger influence on the markets than anything else?
Oh, do you have any easy questions? Yeah, you know, the stock market, when I say the stock market, let's talk the American stock indices is what I mean. It had made a high, I guess, in October of last year, and then kind of had a soft, the second half of October it dipped down. I think maybe just some profit taking or whatever you want to call it in front of the election, the uncertainty about the election. But a day or two before the actual November 3rd election date, a lot of markets found a bottom around about that time. Certainly crude oil did, and the stock indices, that sort of thing. Oftentimes, I guess over the past couple of years, I've talked about those kinds of things as being a key turn date. When a number of markets all turn on or about the same time, you know, it seems to be some sort of a red flag. You know, hey, pay attention. This is something important is happening. But, you know, the market started to turn higher. And then, of course, just a couple of days later, on the 9th of November, the vaccine news came out. And I remember that Pfizer news came out about an hour before the floor session in New York started. And the overnight Dow Jones that we trade in the futures market jumped about 1,400 points. It was like, wow, that was a major move. So there's been a couple of things here, I guess. Let's kind of go big picture. The market is expecting, obviously, that the new Biden administration is going to spend money, lots of it. And they're going to spend it in a way to try to stimulate the economy. There's thinking that says, you know, that when the government puts money into people's checking accounts, that's much more effective at getting the economy going than the Federal Reserve just lowering interest rates, which was really the essential item that the authorities used following the great financial crisis. So fiscal stimulus then thought to be more powerful than quantitative easing. And it looks as though, you know, the Biden administration has got this agenda to spend a lot of money, certainly a lot more than they're going to be taking in. So that's part of it. The vaccine issue, let's say, the anticipation that vaccine might put an end to the spreading of the virus, you know, that's very positive. Certainly the COVID virus and the different variants that we've had since then, since it started to go around, have been a drag on the economy. I mean, lockdowns happen. People don't go to work. Businesses shut their doors. You know, the governments don't get taxes. GDP goes down. So there's been a drag with that. And if that is going to end, then, you know, happy days are here again. People are talking about pent-up demand, like people that have been locked in their homes are going to run into the streets and start spending money on all kinds of things, you know, and that may happen. We've also got interest rates at the lowest they've been in ever, you know, let's say. So one of the ways I look at that is that people that probably should be savers, just putting their money in GSCs or short-term government paper or what have you, have become traders. You can't make any money owning government bonds, so gee whiz, let's buy Rip Snort Resources, or whatever. And there becomes a fear of missing out, so people come flooding into the market. So the psychology, whether it's, the Robin Hood traders or, your grandma decides maybe she ought to shift some of the money that was in the GIC account into something that's tied in some way to get more of a gain if the stock market goes up. And certainly the financial institutions out there are creating that kind of product that would say, hey, GICs don't give you anything, but if you put your money in and the stock market goes up, then you'll get a little sweeter deal. So certainly that's going on. The pro-risk psychology has been very strong. It's amazed me a bit. I'm anticipating that it's probably a bit overdone, but one of my saving graces is as a trader, saving my own money, that is it's easier to make money shorting things that are going down. If you're shorting things that are going up, you don't make money that way. In terms of the second half of your question there, politics has always had an impact on markets, but it certainly seems that lately it has a bigger impact. Perhaps we're in an era where people look to government more than ever, to fix this and fix that. Perhaps then, the government responding to what the people want. The people vote in guys that say, hey, put me in office and I'll spend money on you. Perhaps that's part of it too. So, and I think part of that, what the people are looking for the government to fix is to end the virus right now. Get the vaccine rolled out and have it be effective. Spend the stimulus money. And so instead of people that are typically, say, working in the service industry, being at home and getting a government check, they'd be able to go back to their job and so on and so on. So, it's also, Jim, it's been a bull market for several years, and the market just will run until it stops.
On your website, victoradair.ca, and in other media interviews, you've been talking about the importance of intermarket relationships. For example, you've noted that the U.S. dollar's been trading lower for the past 9 months, while stock and commodity prices have been trading higher along with the stocks. Why are those intermarket relationships important, and how do you use them in your trading?
I've been very interested in intermarket relationships, I think, my whole career as a commodity broker. And I remember years ago describing it on the radio as saying, picture the pits, the Chicago pits, and everybody knows, the whole bunch of hundreds of guys screaming and they're waving their arms and all that sort of thing. But the guys that are in that pit, that's sort of the epicenter of a market and trading something, whatever it is, doesn't matter. But from time to time, they're going to be turning around and looking, and up on the walls, there's going to be the prices of what's going on in other pits, in other places, in other markets. So, as I would say, if you're trading, say, soybeans, you don't want to be the last guy that notices that the interest rate market has just done something. So, or another way of saying this is that there is no market that trades in splendid isolation, that is not affected by what's going on in other markets. And I remember truly, it's got to be 20 more years ago, interviewing Jimmy Rogers, and I'd been very taken with his career and the books that he'd written and his perspective on markets. And at one point in the interview, he said, "Victor, how could you possibly trade wheat in Chicago if you didn't know what was happening to the price of iron ore in China?" And I thought, wow, that's amazing. So anyway, markets do have an impact on one another. Let's take this for instance. I mean, in 1981, in the United States and Canada, interest rates hit the highest they've been in, virtually forever. And since then, okay, we're talking more than 40 years, interest rates have been trending lower. And that has had an impact on all other markets. I mean, I'll tell you what, if the 3-month T-bill rate was still at 15%, we wouldn't have the Dow or the S&P up where it is now. I can't imagine. It probably could happen, but I just can't get my mind around that. So falling interest rates has certainly had an impact on other markets. Think about, say, the real estate market, what it would look like if we were still having mortgages at 15%. Home prices might not have gone up anywhere near as much as they have. So intermarket relationships, I pay attention to them. What I have noticed since the virus crisis hit big time in March, April of last year, since that point, the U.S. dollar has trended lower, while stocks and commodities have trended higher. So we would say that the U.S. dollar is negatively correlated to stocks and commodities. And again, I'm just talking the broad indices. And we can get into why that is. We want to talk about currencies in particular, but when I see a strong correlation between things, I may wonder why, but what I'm thinking is we may have seen the U.S. dollar make a low recently, very recently, about a 32-month low, and start to turn a little higher. And if that's the case, then that will have ramifications for all these other markets that we trade.
We'll have more with Victor Adair right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome back. We're speaking with Victor Adair. Victor, in your latest trading desk notes, you point out the U.S. dollar index hit a 32-month low the day the Capitol building was stormed, and then the dollar went higher. You speculated that could have been a cathartic turning point for the U.S. buck. Tell us why, and what does it mean?
Yeah, I've traded currencies, Jim, for more than 40 years. And if there's one thing I've noticed about currencies is that they tend to trend more than some other markets, and that's just anecdotal sense, but just I kind of noticed that over the years. And one of the things about the trends in currencies is that they often go further than seems to make any sense before they turn, and then they turn on a dime and go the other way. So just something I've noticed, again, over that 40-odd year period, is that many times the relationship between the U.S. dollar and the euro, and that's absolutely the key cross rate, as we call it, in the foreign exchange market. And by the way, prior to 1988, we've got a surrogate for the euro where you have a weighted basket of the other European currencies. But overall, and you could even just say the Deutschmark, from 1980 to 2000, that the cross rate between the U.S. dollar and the euro will make a turn in January. I don't really know why that is. You could speculate why, but I've just seen that does happen. So in a way, it wouldn't be surprising to see the U.S. dollar make a low, well, as you say, a 32-month low. And by a cathartic moment, I mean, I was watching on the television and seeing these people storm into the Capitol building, and I thought, oh my gosh. And I'm thinking, what is the world seeing when they're watching this? And it was almost let's say, from a sentiment point of view, it was the opposite from as good as it gets. It's kind of like, it can't get any worse than this. Well, of course it can, and it can always, things can always get better than this and so on. But I just thought maybe that was just a cathartic inflection point where the bearishness on the U.S. dollar, and by the way, we look at the positioning in the market, who's long, who's short, what the size is and all that. To put it in plain language, everybody and his dog is short the U.S. dollar, okay, in size. Like we have bigger net short positions against the U.S. dollar in the futures markets than ever. Okay, so one of the things too, Jim, the U.S. dollar used to have an interest rate advantage over other currencies. That's gone. I think part of the thought of, all of the printing that's being done in the United States, again, to use colloquial language, if you're printing more and more dollars, that dilutes the value of dollars that are already out there, and therefore anything that's priced in dollars, whether it's euros or Canadian dollars or stocks or commodities, should go down in price. So, I'm thinking maybe, and underline maybe, that dollar had an inflection point on the 6th of January, and if in fact it did, because of these intermarket relationships, that could have a big impact on other markets as well.
We'll have more with Victor Adair right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, if you think the U.S. dollar may be headed higher, what does it mean for other currencies, especially the Canadian loonie?
The Canadian loonie. Canada hit a low last year in that March period of about 68 cents. We're now, about 79 cents. So it's a 16% increase in the value of the Canadian dollar in the last 9 months. That's the Canadian dollar against the U.S. dollar. I should point out that the Australian dollar in the same period of time, got into a much deeper hole back in March and has had a much stronger rally. But that's kind of been the pattern, if nothing else, of all currencies virtually against the U.S. dollar. And I have to do a little segue here. The emerging market currencies have not come back, say, as much against the U.S. dollar as what we would call the developed market currencies. The key currency is the euro, as I mentioned earlier. I think if you added up all of the currency trading that happens in the world, the U.S. dollar against the euro or British pound against the Japanese yen or what have you, you would see that, virtually 40% of all trading is going to be the U.S. dollar-euro relationship. Maybe I'm wrong to pick that number, but just to give you a perspective as to how important it is. That's just the most important cross rate out there for volume anyway. Canada has rallied. I mean, you could see it from even on very short-term time frames. If the stock market in the United States is up, the Canadian dollar is up. If the commodity market is up, particularly crude, then Canada's got a bid to it. If the U.S. dollar is weakening, as it has been over this period of time, Canada has got a bid to it as well. Those were sort of the three things. And doesn't it sound familiar? U.S. dollar is down, stock market is up, and commodities are up. Therefore, Canadian dollar is up, and that's what's been going on. So if then the U.S. dollar has had this cathartic inflection point, and I'm guessing here at this point, then you think the Canadian dollar has probably gone too far too fast. Now, Jim, we got to talk about time frame. And I'm thinking, and we'll maybe talk about this more when we get into commodities, but I'm thinking that the commodity market may have very well made a very important low back in March when everything was going down. All risk assets were going down. And particularly, I guess, we'll get around to talking about stocks relative to commodities. But if the commodity market did make that important low, then we probably also made an important low around 68 cents in Canada, and Canada would trend higher if the commodity markets are going to be bid. But we'll see. Canada is, you look over a 20, 30-year chart, and the Canadian dollar versus the U.S. dollar follows very much the same pattern as the commodity market. So I'm thinking commodities made an important low. I think Canada, even if it had a correction here, may be headed higher over the next couple of years, along with commodities if they are.
You recently published an article showing that commodity indices are the cheapest they've been relative to stocks in over 100 years. Are commodities a buy?
So, short answer is yes. Timing is the issue. I just got through saying that I think we made a very important bottom in the commodity indices back in the spring. Yeah, you look at a ratio. Let's do it this way. The commodity markets, since I've been involved, we had a commodity bull market in the 1970s, and that was very much an inflation-driven commodity bull market. We had another bull market in commodities that started roughly around the year 2000 and ran for 10 or 11 years, and I call that the China bull market in commodities. Also, during both of those periods, the U.S. dollar was relatively weak against other currencies. So, inflation, weak U.S. dollar, and a big bid from China in the second case really helped the commodity markets go up. From the 1980s until, say, 2000, the stock market way outperformed commodities. Commodities had their run up from in the 70s and kind of peaked out around 81 and kind of dribbled off sideways, and everybody started getting into stocks. So the ratio really went in favor of the stock market. From that 2000 period, which was when the dot-com bubble ended, the ratio of stocks to commodities fell. So commodities were going up at that time, the China bid, and stocks were falling relative to commodities. So we've just had these swings through time, and instead of trying to illustrate a chart here with my talking, just to say that we've seen lately, last few years here, that the stock market has been so aggressively bid, it's just left the commodity market behind, so that the ratio between stocks and commodities has gone hugely in favor of stocks. That doesn't mean that it needs to shrink. I mean, you could even have the ratio shrink if stocks and commodities both fell, but the stocks fell faster. I just think that it could happen, and one of the things that I was thinking and wrote about in that article was that for a lot of people, they have hedged to some degree their stock holdings by also owning bonds. The classic is the 60-40 portfolio. We've got 60% of your assets in stocks and 40% in bonds. The thinking is if stocks fall, bonds go up, so you have some kind of a hedge there. Now that we got interest rates down near zero, and maybe they can go deeper negative, but maybe, I'm suggesting, and this is more institutional money, but individuals could think about this kind of thing, maybe you don't hedge your stock position with bonds anymore. Maybe you hedge your stock position with commodities.
Yesterday, gold traded as low as $1,800, which is nearly $300 below the all-time highs hit at the beginning of August. Gold has trended lower for the last 6 months, while the U.S. dollar has also trended lower. Is that unusual? Why has that happened, and what do you see ahead for gold?
Yeah, I mean, over a multi-year period, let's take the last 20 years or so, you got a pretty good correlation in terms of if the U.S. dollar is weak, gold is strong, and vice versa. And I don't think that is dead and gone. I think that's important. But you have these shorter periods of time where, say, gold and U.S. dollar could both go up at the same time or both go down at the same time. We've just gone through a period like that. The the last couple of years, gold has been very correlated with real interest rates. So let's say a couple of years. Let's go into the late summer, fall of 2018 through to now. Real interest rates have gone increasingly negative, and that was bullish for gold. So in a way, the relationship between real interest rates and gold kind of took over from the relationship of gold and the dollar. As we talked earlier, I think the gold market this past year really benefited from massive ETF buying, beginning around the crisis lows there in March and running through, actually through to about July. It started to peter out. And then since the high that was hit in August, we've seen I shouldn't say net selling, but we've certainly seen selling in the ETF market. And as I mentioned before, that was very important because two of the main sources of buying in the gold market, the retail market, China and India, basically just closed their doors. So if it hadn't have been for all of that ETF buying, and by all of that, I'm talking, for the year, something like 750 tons of gold bought by the ETF market in 2020. So size. Lately, I think after gold hit the highs in the beginning of August, and if you may remember, the stock market was pretty frisky in August. I think there was a little bit of an attitude of like, who needs gold? It's had this run up, made new all-time highs, but now it's kind of coming off a little bit. So let's take profits on gold and plow it into the stock market. I think that's part of what's been happening. Now, again, timing, short term, longer term. I think the sense that all of this money being printed, as it were, in the United States in particular, but around the world, is going to be a very solid underpinning for gold, and I would expect that the gold price will continue to go higher in sort of relative to a surplus of cash being put out there. And as something goes along with that is, it seems as though there's going to be a lot of government spending, but the central banks are going to want to try to keep interest rates low. And when I say want to try, they're certainly going to do that. Let's maybe in some respects hope they don't fail, because then all hell will break loose. But if that happens, then that puts the bond yields more deeply negative, and that's definitely a positive for gold longer term.
WTI crude briefly touched the low of $34 November 1st. Now it's around $54. That's nearly a 60% gain in just 2.5 months. Why the big gain? And why do you think West Texas crude will continue to rally?
Well, the crude market had that spectacular low of minus $40. This was the WTI market in April of last year, and that was very brief. I'd say, roughly the real low was about $20 a barrel when you look at other grades of crude that weren't subject to the specifics of WTI at that time. And the market started to rally. Certainly since November, we had a $34 low right before the election. As I was saying earlier, that key turn date, the stock market had sold off in the second half of October, and then things started to get better. And certainly with the crude oil market, one of the, I guess maybe the major drag on the price has been the lockdowns that have happened all around the world to try to contain the virus. Lockdowns, people aren't going anywhere. They're not using fuel for transport. And I think, roughly speaking, we had year-over-year demand down about 10% from where it had been the previous year. So that really put pressure on prices. Now, on November the 9th, the Pfizer news, the crude oil price jumped, as did the other risk assets, particularly stocks. And I think there's been a looking ahead, or let's say looking beyond the short-term struggles that the market's going to go through, the economy is going through. People are buying crude thinking that, the vaccines are going to make the virus stop spreading or go away, and then people will want to go traveling, particularly maybe even more than they did before, because they've had to stay at home. So there's been some of that kind of thinking, I think, in the crude market. It's also just been a general pro-risk market psychology is lifting risk assets. I'm particularly pay attention to the forward spreads, or time spreads in WTI. And backwardation now has really happened. That is, the front month prices of crude are much higher than the back market prices are. So that would indicate maybe a strong near-term demand for crude. And paying attention to the forward curve, as we call it, sometimes gives you maybe it takes some of the emotional spin out of what's affecting the crude oil market. And on the other side, Jim, is the supply side. OPEC had their meeting here a couple of weeks ago, and sort of to the surprise of everybody, the Saudis just volunteered that they would cut a million barrels a day out of their production. So, that's given the market a lift. So, sum that up, and we got in too deep of a hole to start with. The market started to come back, find some kind of an equilibrium. There's been a pro-risk psychology across markets, and WTI got part of that. The vaccine things have been very positive, and now Saudi's cutting some of the production. Is the market ahead of itself? Yeah, probably. But that's kind of how we got here, and we've had, as you say, a 60% run in 2.5 months. 60% run. That seems maybe a bit too far, too fast. But I'm not short crude here.
Copper prices are around $3.70, a 7-year high, up over 80% from the lows made last March. Soybean prices have gone from $8 last April to around $14 now. Has the commodity boom already started, and maybe for some too late to join in?
Yes, I think it has. As I said earlier, I think the very important low we had in March of last year in the broad commodity indices may well be seen as a multi-year low. Jimmy, I think if I was to try to describe it this way, I'd be looking for the rally that we've had here off the lows in commodities probably to have a correction. And again, the if would be if indeed the U.S. dollar is turning a little higher, because all these markets do not trade in splendid isolation from one another. They definitely impact one another. I think the commodity market and it's been a brutal bear market, by the way, for the better part of 10 years. There's been, where money, let's say, didn't get allocated to the commodity market and got allocated to all kinds of plays in the equity market. So in a real big picture point of view, there wasn't money spent going out and developing, new sources of supply on the commodity side. And, if we get an uptick in demand, that may give prices a spike. So, yeah, I think the commodity market may have started higher. I said we had that rally back in the 70s. We had another in the first 10 years of the 2000s, from roughly the year 2000 to 2011. And maybe we're going into another, in terms of timing, another cycle of that magnitude. So we'll see, and we have to pay attention to the price action.
Anything else that we should take a look at before we wrap it up?
Well, I think I probably went a little light on interest rates, but the interest rates, I think this is going to be very, very key because they're going to affect all these markets. There's been a lot of debt being issued, whether it's, mortgages at all-time lows here, certainly, spurring the real estate market. But a lot of debt out there. There's the broad acceptance, or at least understanding agreement with modern monetary theory, which says, you can just spend all the money you want. It doesn't matter. The Fed is saying they want to see inflation run a little hot, and they're going to try to keep interest rates low until the economy really gets going, and particularly until employment comes back. So I think I know this is consensus thinking, but certainly sometimes consensus has it right, that we're going to see an uptick in inflation. And for years, I've been a deflation guy. I'm saying there's just so many things out there contributing to deflation. And I'm changing my tune, I think, on that. And maybe that's part and parcel of why I see a commodity market doing better. It'll be very interesting to see if the Fed can keep the bond market down. I mean, we certainly see the ECB in Europe is able to buy enough Italian bonds so that Italian bonds are trading, very tight to German bonds. And if it wasn't for the ECB, that wouldn't be happening. So the central banks may be more powerful in that respect than some people want to believe. And as a wrap up, if we're having one of these, new eras, I mean, we got a new president elected today. This is going to be a different government than the Republican government, going to be maybe very different. I think, some of the, call it the old metrics or the way we have gotten used to looking at things is going to have to change. It's just, you're going to say, well, this and that I understand, and that therefore that means that. And you go, no, you're wrong about that. So trying to make sense of the new era, as it were, in terms of old metrics, may be expensive. So I just come back to my bedrock, I guess, and that is you got to watch price action. You just don't think you can figure it all out, but watch the price action, and the market will figure it out for you and show you what's going on.
Victor, thank you so much for chatting with us.
Jim, it's always a pleasure. I look forward to this, and let's do it again.
My guest has been Victor Adair, recently retired from nearly 50 years of being in the brokerage business in BC. Check out his website, victoradair.ca. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.